Welcome to the Property Corner with myself, Rowan Alexander. Welcome back. On today's episode, I'm going to be giving you some tools that you can use to evaluate investment decisions when purchasing property. When I first started off investing in property, the market was substantially different to where it is now. I mean, we're talking 13 years ago that I bought my first investment. And at that point in time, the rental income was more closely related to your mortgage repayments. Interest rate cycles, at the time were lower. We'd also come off the back of a recession. Property prices were slightly lower. They were busy recovering. Today, we're coming off a cycle where property prices have increased quite dramatically, especially in Cape Town. And rentals haven't followed, that same pattern. We discussed this in previous episodes, identified things like COVID, the effect that had on the rental market. And we've offered insights before as to why the rental values haven't tracked and followed the sales values. That's changing. We've also reported on that, explained why we see that changing and how we see that changing over the next 18 to 24 months, because it certainly is. But at the same time, there's the strong correlation between interest rates and purchase prices and rental. And often I hear people say, well, we'll wait until interest rates sort of drop, and then we're going to try and make a decision to purchase, because they're trying to time the cycle. The reality is that what makes property investment lucrative is the fact that you can make use of mortgage finance to actually fund your acquisition. And that's that concept of gearing that we've also discussed previously. Now, with there being such a close correlation between rental or mortgage installments and interest rates, and then ultimately pricing, what I've found over the years is that as your interest rates decline, property values start escalating more aggressively. Similarly, when interest rates go into their higher cycles, the property values escalate slowly or to a slower extent. Now, if you then try and find that equilibrium, well, where do you invest? Do you wait for interest rates or pricing? That waiting, you're going to get penalized for waiting. So if you enter the market when interest rates are low but prices are high, or the inverse, over time, I've found that those two effects have nullified each other. I've made those investments when we've come off the peak of interest rate decisions, or the peak of interest rates as well as the peak of pricing, and in the long run they've all done the same. Because the two are so closely related, it really makes no difference. What does change though is the amount of cash that's required to actually acquire the property. And that's the reason, that's part of the discussion today, is how do you find a way that we can go back to purchasing a property and funding that investment with only 20 to 25% of the purchase price? Because that's where it all started off for me. And that was very lucrative to me, because if I was in a position where I could buy a property that breaks even from day one, but also has good capital appreciation, that would be the best case scenario. But 13 years ago, I could do that with only 20% of the purchase price. Today, the market is at a level where I'm probably going to need 40 to 45%, if not more, in cash equivalent for the property income, the rental income, to cover the bond, completely. And that's directly because property prices have escalated quicker than rentals. So again, we're seeing that changing in the future. Over the next 2 to 3 years, I see that changing back to a more natural level where rentals follow your installments more closely. But while we're not there, we can't sit on the outside and just let the opportunities go by, because we're also missing out on the capital growth in the most explosive time of capital growth. So I'm going to try and show you a way that I've found a workaround for myself, but I've also been recommending to my clients is a different approach to, with the same equivalent of cash, be able to engage in the market and get that foot in the market and not just sit on the sideline. The concept is that there's one of two ways to get your property to break even. I'm not looking at a scenario where you buy a property that's rental income is equivalent to the mortgage installment from day one. as I've said before, you guys will know, as a audience that follows me, you'll know that I prefer investing in a market where there is a rental shortfall, but my capital growth is ultimately what's going to make the good money. So there's two ways of achieving that from the outset. The first is to offer a deposit. By offering a deposit, you reduce the monthly installment, and you find that balance between rental income and your mortgage installment. Now, saying that, as I said, 13 years ago, that sum was 20%. Today, 40 to 45%. Becomes far more cash intensive, and you simply, it becomes hard to afford. So to get back to a position where I can, with 20% of the purchase price, get the property to break even, I've moved to a space where we opt for 100% bonds over the longest possible period that the bank would be willing to offer to get my installment as low as possible. By having that installment as low as possible, the gap between my installment and my rental income is as low as possible. Over time, as the rental increases, that gap becomes smaller. So in year one, I might have a larger shortfall. As time goes by, that shortfall becomes less and less and less, ultimately up until a point where the property starts breaking even because the rental values have grown to the point that it matches the mortgage bond installment. So in summary, just to clarify, what we're trying to do is in the past, the deposit that was required to get the property to break even based on a net rental income was 20, some cases 25%. This value is now up to 40 to 45%. The flip side of that is actually looking at funding the shortfalls between a full mortgage repayment and the rental income, and then doing a tally and calculating what would the cumulative shortfall be up until the point that the property starts breaking even, and see if there's a more cash-friendly way to execute this option rather than the big bulk deposit up front. So as a side note, Klein de Koning is a project that myself and my team have been tasked with marketing. It's found in Durbanville, as I've mentioned already. And if you're looking for more information about this project, you can go to www.kleindekoning.co.za, and you'll be able to find all the information, the prices, the plans, more information about where it is and what it has to offer. Today's episode will give us a summary of that. But if you are looking for that particular project, if that speaks to you, pop over to kleindekoning.co.za and have a look at what it has to offer. So I'm going to show you an example of what I mean to put this into context. I've taken a summary of a project that we've recently launched called Klein de Koning, where we're selling duplex homes for 2,390,000 Rand, and we project a rental income of 17,500 Rand a month. To get my net rental, I need to take my rental income of 17,500 and I need to deduct my operating expenses. In this case, it's my levy and my property taxes, and because it's a sectional title scheme, my insurance is already included in my levy. Thus, the net rental income that I would generate would be 14,372 Rand a month. The loan, if you look at the loan terms that I've put in a loan of 2,390,000, which would equate to a 100% bond, an interest rate of 10.75. For those who know that at today's date, our current interest rate is 11.75, the prime rate. Banks are offering below prime loans to clients, and we are easily achieving 10.75. And even more so, we are going into a period of lower interest rates over the next 12 to 18 months. So I think working on an interest rate of 10.75 is realistic, because this project will only be completed in 2026, where we would have already probably gone down to the lower interest rate, or combined with the lower interest rate cycle and the subprime loan from the banks, you would easily achieve 10.75. Something that you would have heard me talk about in previous episodes is taking the maximum loan term of 360 months. And that's simply to get my mortgage repayment as low as possible. In this instance, it calculates to 22,310 Rand a month. putting that onto a schedule, we can start looking, forget about the dates that I've put in here. I'm just using 2024 as the starting year. In reality, for this project, it would be 2026. But we're saying that in the first month, my net operating income after my expenses have been paid would be 14,372. My mortgage repayment, 22,310. And I thus have a shortfall of 7,938 Rand. That's in month one. On the far right, I'm then totaling every month. As every month goes by, there you can see at the end of year one, at the end of year one, start of year two, my monthly shortfall becomes less. That's because my rental income has grown. I've projected a rental increase of about 7.5%, and that gap starts closing. I'm not too worried about that gap at this stage. I'm trying to see at what point in time will this property actually start breaking even, where net operating income equates to my mortgage installment. And if we look at this, it's at about 84 months. So 84 months later, my rental income and my mortgage installment basically cover each other. I actually start going into a positive from month 85. And the total that I've taken out of my pocket is about 358,000 Rand. So let's call it 360,000 Rand. Now, 360,000 Rand is what it's going to cost me to fund this property from day one up until the point that it covers itself. That's the alternative to putting in a 360,000 Rand deposit up front. This is only about a 15% of the purchase price. Now, going back to our summary at the top, if my loan amount of 2.4 million or 2390 has an installment of 22, and I'm getting a net operating income of just under 14.5, I'd probably need to offer about an 800,000 Rand deposit up front if I wanted this property to break even from day one, if not more. The way that I've explained now, you'll see that I'm able to achieve that break-even point with far less cash. And I've got the benefit of actually repaying that cash over an 84-month period rather than from day one. So this gives me the ability to actually access that market and not sit on the sideline. I can be in the mix again. I can be part of the capital growth over that period of 84 months. Now, you might say to me, Rowan, but I want to get this property paid off as quickly as possible. Remember, that's not my strategy. My strategy is the alternative to taking 360,000 Rand, going and investing it in a different bank account and getting interest on the 360,000 Rand, every year, 36,000 Rand or 40,000 Rands worth of interest. I'm looking to get capital growth on the full purchase price of 2.4 million Rand per year. In Cape Town, we've been fortunate that our capital growth in these sort of projects have been at the 8 to 8.5% per year. And that's probably close to around 200,000 Rands worth of capital appreciation every year on this property. If after an 84-month period, I'm in a position where I've had 7 years worth of capital growth at an expense of 360,000 Rand, if I go and do that sum, those returns would probably be unmatched. And that's the beauty of being able to finance a property. This approach is one that allows me to get back into the market with less cash than what I would require to put it in upfront. And it's a way that I've found to keep myself relevant in this market and help my clients be relevant in the market where cash may be under constraint, but they still have the appetite to be in the market to capitalize the capital growth that we are experiencing. Another thing that people often ask me is to say, well, Rowan, you haven't provided for any vacancies, you haven't provided for if people were to move out. And that's true. I haven't taken that into account because I don't know what that uncertainty is. I can't value that uncertainty at this point in time. But what I do know is that this is a cheaper cash method of investing. I'm able to achieve this with about 15% up to 20% equivalent of the purchase price. And I have typically a 5 to 8 year period to make those shortfall repayments rather than parting with my cash up front. If over that 6 or 7 year period I had people moving out and the property stood vacant for, let's say, another 6 months, in that 6 year period, because tenants change or someone, wasn't in a position to pay for a couple of months, what would happen? My investment of 350,000 might potentially go up to 450,000. But still, in the greater scheme of things, when I take into account the 200,000 Rand per year capital growth, of 1.4 million Rand on this property versus the 400,000 Rand investment that I've had to make over that 7 year period, it still makes absolute sense. So it's not a perfect science. And you could stick many holes into this argument if you'd like. And I myself could. But that would prohibit me from entering into the market. Now, I'm trying to find ways to stay relevant, trying to find ways to make it as affordable as possible to actually benefit from what's happening in the market. 5 years from now, these sums will be different. 2 years ago, they were different. 2 years from now, they will be different. But we need to stay relevant. We need to find ways to capitalize on these markets that are ever changing. And this has been something that I've been very reliant on over the past 4 to 5 years. It's worked very effectively for myself as well as for my clients. I hope this helps you contextualize maybe some of the purchasing decisions that I have been motivating, and maybe give some insight into how I make these decisions and how I recommend these decisions be made, rather than sitting on the sideline waiting until you have enough cash to actually be able to offer a deposit up front so that the property breaks even from day one. The risk, with any form of investment, there's risk. And this is very often the case, is that clients say to me, Rowan, I don't want the risk of a monthly installment. I want to be able to offer that deposit up front. And I would go and say, well, if you have the cash equivalent in deposit, if you are able to get 100% bond, just park that deposit in a separate account and let your rental income come into that account and let your expenses go off that account. And that cash reserve that you have will just diminish over time. It will offer you that same peace of mind as a deposit up front would have. So I hope this episode's been useful in maybe sharing some of my ideas, ways that I view things, and helping you find ways to actually be part of that market, capitalize on the capital growth that we are experiencing. Because sometimes if you look at these figures and the rental incomes and you see the bond repayments or the purchase prices, they don't make sense and we could be crippled. But I believe this tool and this analysis helps us put perspective to the opportunity and helps us stay relevant. So I hope you've enjoyed it. In the next episode, I'm going to be looking a bit more closely into this analysis as to what you would actually get for your money, and contextualizing this investment decision. But also, if you have any questions, or if you want to see some more of this sort of stuff, or you've got any particular questions, drop them in the comments and we will gladly answer them. So thanks. Hope you've enjoyed this. Stay tuned to our channel for more of this content.